everybody. This is Rob Keents with the Freedom Report. We got our gold and silver report out today, Friday, October 18th, 2024. I got a lot of stuff on silver and then some stuff on gold. We're going to jump right into it. To start off, I want to show Andy McGuire over at Live from the Vault on the Kinesis channel talking about what he's hearing in silver on the wholesale markets there across the pond. I think it's very interesting. And then we're going to dive down into some of the data he talks about and then some additional data on silver. Looking very bullish. Of course, we had a breakout. We'll go over the price chart here in a minute. But without further ado, let's go ahead and get Andy on screen and listen to what he has to say about what is going on in silver from his spot across the pond.
You'd like this subject, Shane. In fact, it answers some of the. It's funny, we were shooting the breeze a little earlier, and it actually amazingly answers some of those questions. So, yeah, we ran. I think we ran out of time last time. I was going to cover some more about silver, but following some very high level end of third quarter meetings with our liquidity provider group, what was really notable was for the first time since the end of the first quarter, silver was very, very high on the agenda. In fact, it was the main subject matter. So off the back of this, let's start by looking at silver, which, as attested to by this linked metal focus report, it really confirms what we and the COT insiders already knew. So I've linked it right here. Now, what is glaringly obvious is that the majority of CTAs who follow the likes of Bloomberg analysts and that kind of, and CNBC and all that kind of group of market analysts, and for all the wrong reasons, they haven't once reported on silver since the 2020 silver short squeeze, which was pretty hard to ignore. And these COMEX-centric speculators who actually, and we've covered this before, they drive about in excess of 75% of all the open interest, which is the borrowed casino chips, basically. They don't have any view into the underlying physical market shortages. They view synthetic silver, exchange traded funds, and shorted positions or long and short positions in the COMEX. They just look at it as another stock to be shorted inside the casino's chart-painted ranges. And while it's assumed, it is the first-tier banks that are, it's assumed that the first-tier banks are betting naked short against silver. And while they are, from time to time, and I'll explain why, it's largely the speculators who we identify as the momentum traders utilizing this 75% of all the casino chips, who've been lulled into years of chasing from an insider determined pillar to an insider determined post, their ranges that the insiders determine. It is this group of synthetic traders we've labeled the cartel's useful fools. Now, whale-sized footprints evidence cartel bid pulling efforts timed to regularly milk these highly leveraged spec casino chips, borrow from the house, but just enough to keep this lucrative game running. If you're a cartel, you can do this, and it's not physically deliverable. It's not Basel III compliant yet. However, concurrently, spearheaded by Goldman Sachs and inclusive of this entire group of market-making LBMA cartel so-called professional trade, without exception, they're all betting on silver to rally to over $37 and are regularly taking the long side of bear-trapped, highly leveraged naked short bets. But what's notable is because the unallocated fiat-diluted silver market is increasingly circumventing London and being settled in bricks-facing allocated physical form, the lines have crossed. And all the major liquidity providers see silver catching up with gold, and they are ready.
Okay, so essentially what he's saying is the casino's about to end, and the way that it works is the useful idiots in the casino that essentially control the trade within an established range. What he's talking about is that was institutionalized. If you go back to the findings from the investigations from the Department of Justice and the Treasury and the CFTC, a lot of people that were in those banks trading it said it was institutionalized. We were told to trade it this way. They were told to short it. They were, you know, regardless of what the market said, they were trying to paint the tape within certain ranges and make money on those trades. But that's all unraveling because the BRICS nations are now taking the metal off of the market, and there's less and less physical to support the derivative trade. It's something we've been talking about for the last couple of years, and Andy so eloquently put it, based upon some evidence he's seen, and we're going to put up all that on screen. So let's go through the silver evidence. Looking at a report from Wall Street on Parade, and this is on October 7th, so very recently, about 10 days ago. A bank regulator provides a frightening look at trading casino, blah, blah, blah. I want to go down here and show you the derivative trade. Right here, notional amounts of derivative contracts by contract type and maturity for precious metals. And I'll show you where they got this information from. You can see that there are basically a few, let's see if I can blow this up. I'm having issues with this chart. Here we go. So you can see 4 major banks that do all the derivative trading and their position within the physical precious metals. JPMorgan leads, but you've also got Goldman Sachs to a small degree, to a larger degree, Citibank, and then Bank of America. Precious metals maturity of less than a year, greater than 5 years. Most of the derivative trades are less than a year. Every once in a while, you'll get something, you know, 1 to 5 or 5 years if you're really looking at long-term risk. But most of the casino trading's on the short term. That way they can get in and out of the trade and make their money. Wall Street and Parade had this great report over what's going on and the risk to JP Morgan. And they're saying here, the concentration of activity by one bank in the precious metals is being tolerated by federal regulators, despite the fact that the U.S. Justice Department criminally charged JP Morgan Chase just 4 years ago when engaging in tens of thousands of episodes of unlawful trading in the markets for precious metals futures contract. The bank admitted to the charges. Well, here is the Office of the Comptroller of the Currency report. This is where Wall Street on Parade got their data that Andy was talking about in terms of the derivative market and why that's falling apart. And I'll show you on the COT report here in a moment where there's so much shorting going on, but it's breaking because you have the rest of the world coming in the market taking the physical. I've been reporting on this for quite some time, and now finally we're starting to get the evidence and everybody's catching on to what the scheme is. So real quick chart here, figure 8 on this quarterly report. You can see in blue is the futures and forwards owned by the market, a substantial amount. That's all futures, not just precious metals. But if we go down here to precious metals as we cycle through, here's futures and forwards. Note that there are top 4 banks in orange that own most of the derivative market. Those are futures and forwards, swaps, options, credit derivatives, all of it, total notional, means all of it added together. They own the vast majority of it. That's the top 4. All the other banks participating only own a little bit. That's what we talk about in the COT report with the concentration of shorts. There are 4 main banks that are shorting the market. JP Morgan leads in the precious metals, but JP Morgan, Bank of America, Citibank, and Goldman Sachs are the big 4 banks that play in all of the derivative markets across the board, according to the Office of the Comptroller of the Currency. And that's where Wall Street and Parade got their numbers for precious metals. They basically pulled it from this report. And you can see in the report, it's the same 4 banks, but the one that has the most gold and silver is JP Morgan. You see on this number, out of the 433 thousand million dollars, they have 256. So they have the majority. So essentially what you get is they have all the risk. Let's go to the COT report and let's look at what that looks like. Here's silver on the COT report. You can see here that the top 4 traders short own about 40% of all the derivatives. Those 4 top traders would be JP Morgan, Bank of America, Citibank, and Goldman Sachs, with JP Morgan owning the lion's share of it, more than half. And if you go to the COT report, you can see that all of these are in the swap dealers position in silver. They own 65,059 contracts of 5,000 ounce silver to the short side. They're more than 2-to-1 leverage short. They own the vast majority of short positions. You do see the producer merchants have 39,000 contracts, but that's legitimate hedging for product that they're going to be producing and or using. So that's what we call legitimate physical hedging. This is the financialized portion of it. And this is where JP Morgan owns most of that market. So over the years, people have railed on JP Morgan. Why is JP Morgan doing this? Are they doing it for themselves or are they doing it for someone else? We don't really know. It could be for the Chinese. It could be for a group of companies. It could be JP Morgan's house account. But they hold that position that we see on the quarterly report of the Office of the Comptroller of the Currency. And it's right here on the commitment of traders. And they're the ones holding the big short. Well, the thing is, they're holding so much shorts but the price is rising. That is putting tremendous risk on their balance sheet. They could go bankrupt, at least their commodity trading desk could go bankrupt, and it could lead to major issues with the bottom line for the bank, because we're talking about a lot of money. If they ever got called on all these contracts and didn't have the silver. Now, JPMorgan is known to have a lot of silver. They have over 100 million ounces. But does JPMorgan really want to give up that silver to fulfill a contract? We don't think that they do. So what they do is they roll the contracts over and try to make money. The problem is now you have the BRICS nations coming in wanting the silver and the gold, and it's drawing out that physical to the point at which there's not enough physical in the market to cover for JPMorgan's position. So they got two choices. One, they wind down the short position at which the price is going to explode upwards. Or two, they're going to have to give up their own physical silver to deliver on these contracts. So right now we've got another short squeeze going on the market, primarily with JPMorgan and the crosshairs. And that's a big thing. And why is that a big thing? Well, let's talk about the shortages. Metal Focus came out with yet another publication on October 3rd talking about silver mine production. And it says, can silver mine supply meet increasing industrial demand? Here it goes on to state, the silver market has experienced its fourth consecutive year of structural deficit, meaning less is produced every year than the market is taking. And that's why all the inventories that were stored up on the exchanges over time are starting to come down. And that's why if you're JPMorgan with all those short contracts and somebody's standing long and they want delivery, you're not going to be able to draw on the rest of that market. There's not a lot of silver left. JPMorgan may have to give up their hoard or take a loss on those contracts, which is going to decimate their balance sheet, maybe put them into serious financial trouble. Silver mine supply, it says here from Metal Focus, after 2 decades of consistent year-on-year growth, peaked at 900.1 million ounces in 2016. That would be 8 years ago silver production peaked, and has never caught up since then. During that period, according to Metals Focus, the silver price, despite some volatility, averaged $13.30 an ounce. Since 2016, the silver price has averaged $20 an ounce. Our current spot price is $31.50. Actually, it's higher than that, and we'll get to that. Despite these higher prices, mine supply in 2024 is projected to only be 62.8 million ounces lower than the 2016 peak, representing a 7% decline. So even though prices are going up, there's a decline. Looking ahead, the structural deficits are expected to support higher silver prices, which are ultimately going to record highs. Right now, the price inelasticity of silver mine supply is largely due to the fact that 55% of silver is mined as a byproduct of other mines. What other mines are there? Well, let's get a little chart right here. If you're getting silver out of the ground, it's usually as a byproduct or a secondary product of these other mines: gold mines, lead, zinc mines, and copper. Okay, only about 27.4% of mines are primary silver producers that might have other products. The rest of where silver comes from, the other 73-ish%, comes from other mines. And if those mines, if you're shutting down lead, zinc, and copper because you have deflation in the economy, the silver production comes down as well. And then all of a sudden, where are you going to get your silver? So there's been some deflation in some of the other mining sectors in terms of their output, which is putting less silver on the market, hence the supply shortage, as well as the silver is getting harder to find even as a byproduct. The grades are going down. So even if you're still producing the same amount of copper out of that mine, less silver is coming out in the same amount of rock, because you're getting lower silver concentrations. And again, with deflation in the economy and people not buying as much stuff, some of these mines aren't producing as much. And so you're getting lower silver production. This year, approximately 28% of global silver supply is expected to come from primary silver mines, where production is directly tied to silver prices. Despite significant price increases since 2016, primary silver production has fallen. Not only in these other mines, but the primary mines has fallen, accounting for most of the supply decline since the peak. It's in part due to decreasing ore grades, they say here. So everything that I just said. Now they are making some money. If you want to know if they're making money, the dark green on this chart is cash flow from operations. Let's see if I can make this a bit bigger for you guys. So the dark green on this chart is cash flow from operations. Cash flow from operations right here. That's the dark green, this piece right here. So you've seen since 2016, the silver mines, when they're producing, they make a fair amount of cash, even when the prices were in the 20s. Now it's about $26, the average cost to get silver out of the ground. So silver prices have to continue to rise, but they're making money. The problem is not that they're not making some money. The ore grades are going down. 72% of silver comes from other primary mines, and the primary silver mines decreasing ore grade and decreasing investment in those. So in the next 5 to 10 years, it doesn't look like we're going to have an excess of silver at any point in time. Even if you try to get all these mines started, it just takes too long. It takes 5 to 10 years. And so what happens is all of a sudden you've got issues. Now, this is a rising all-in cost, all-in sustaining cost, AISC, for silver to produce silver. In 2019, it was down to like $11 an ounce of silver. It's more than doubled to 24, and the current rate in 2024 is actually $25.75. So it went from $11 in 2019 to pull silver out of the ground worldwide to $25.75 as of right now. That is a 5-year period in which silver, the cost to mine silver out of the ground, has more than doubled, about two and a half times what it was. And so the costs are way up, and that's why it's hard to increase silver production. You got to have a lot of money going into it. And as this report goes on to note, that the AISC is only talking about getting the silver out at the point you do it. It doesn't talk about the hundreds of millions of dollars it takes to build the silver mine in the first place. This AISC number does not account for the initial CapEx, capital expenditure, the money you put to get that silver out of the ground. So we're in a very serious situation when it comes to silver. But oh, wait, there's more. One of my readers sent me this article at Head of the Herd, put out in January of this year. Mexico could run out of silver by 2026, worsening the supply deficit. Listen to this. The world's largest silver producer could mine all of its existing reserves within 2 years, throwing silver's global supply-demand balance even further out of whack than it is currently. Mexico has regularly outputted 5,600 tons of white metal over the past 10 years, but has seen its reserves dwindle to just 37,000 tons of silver. If mining continues at the current pace, Mexico's silver reserves will be exhausted by the end of 2026. Ladies and gentlemen, that's only a year and a few months away. Sorry, end of 2026, 2 years, 2 years and 2 months. That's not very long before Mexico, a top 3 producer of silver in the world, is out of known reserves. Then they got to go explore and get more. And how long does that take? And how many millions of dollars? It's going to jack the cost to get silver out of the ground even higher, because you have a lack of flow. You have a lack of cheap silver. Silver production there is now declining double digits annually for the first time in almost a decade. This year, output is expected to fall by 16 million ounces because of the suspension of operations at Newmont's Peñasquito mine. That was earlier this year. The country made headlines in 2022 when the government of President Andrés Manuel López Obrador nationalized the lithium industry. According to mining.com, the bill elevates lithium to the category of a strategic mineral, declaring the exploration, exploitation, and use of lithium to the exclusive right of the state. Could silver be the next to be nationalized? Well, if you're running to a silver shortage and silver prices spiking, all it takes is the government to say, this is a critical mineral just like lithium, and then nationalize it. And, 10 years ago, I never thought Mexico could do this. But looking at what's going on with their politics and their industry right now, it would not surprise me now if they started nationalizing the silver industry. It's scary. We don't want it to happen, but it could happen. And that could take a top 3 producer either offline, or it could make silver much higher from a top 3 worldwide producer. That's something we need to pay attention to. Last year, the Mexican government passed an overhaul of mining laws, including shorter concessions and tighter rules for permits. The reforms also reduced the length of mining concessions from 50 to 30 years. And they really wanted to do 15, but they got it to 30. Dan Dixon, the CEO of Endeavor Silver, a Canadian firm with 2 producing silver mines in Mexico, said the changes to concession terms would affect juniors' ability to secure finance. Quote, we deplete our resources and need to make new discoveries to replace that supply. It will limit companies coming behind the operators to bring that additional supply on. So in addition to the shortages in the money to get silver out of the ground, the CapEx, the government is making it harder to finance these mines, because you don't just press a button and crank up a mine. It's not like building a web page, or it's not like building an online store to sell silver. Getting it out of the mine takes a long time, and they need long mining leases, exploration, development, and money. And the government's now in the process of making this harder. It says here, the mining code changes also threaten to trigger a wave of litigation in Canada, where 70% of foreign mining companies operating in Mexico are based. Industry group COMEX has warned the legal reforms could jeopardize $9 billion of investment over the next 2 years. According to the U.S. Geological Survey, Mexico produced 6,300 tons of silver in 2022 against the world number 2, China's 3,600 tons, and third place Peru's 31. Mexico's a big player. All right, going on to the futures, we got decent amount of interest in there. Really, I just want to get to the numbers. So we look at total volume, 65,000 contracts. December being the dominant month for right now. That eventually will rotate to March. As you can see, it's starting to build up. Right now, it is December. December is going to be the next big delivery month. Can't have a lot of deliveries now. There's not a lot of contracts in October. Only 10 contracts open. Why? Because we're halfway through October. Why would you have a futures contract open? Block trades 719, Clearport's 1514, EFP 795, and trade after settlement 133. The EFPs meaning you're going to London to try to get it. The Clearport's block trades and trade after settlements that are highlighted here on the top line mean that people are trying to settle off market and bring the trade onto the market. They do it for price volatility, but also to find the physical. Sometimes they don't find it. That is silver. Let's look at the chart. You can see a nice little breakout. If we zoom out on the silver, let's go to a longer term chart. Let's go like a 5-year. Let's go a little bit longer. You can see the long-term chart of silver. Once the Commodities, Act was passed in the early 70s, it allowed silver to float to the dollar on the market, and you had all this speculation. The COT report that we show you, the COT report, all the speculation started basically in the early to mid 70s, and it's caused silver price go up and down depending on demand. We can see it hit 50 here, it hit 50 here. Okay. And it's broken out to its third of 5 Fibonacci's. What does that mean? It's third of its 5 big trading ranges, but it's broken out lately almost to the fourth. And once it gets to the fifth, it's going to run up towards $50. Here's your $50. But right now it's trading about 33.63. We have a nice breakout this week in silver. It was gold's time. Let's look at gold. Gold is broken out into its final trading range. You can see here, it's the last little trading range for gold. It's been that way dating back to March. Gold's broken out since March. Silver's marching up that chain. And when it gets, right now, when it gets to 35, it's clear sailing to about to 37.50 and then to about 47.50 to $50. Those are going to be your resistance points. So we'll see what happens in silver next week. It looks like we're probably going to end momentum here. I'm reporting this about 3 p.m. Central. The market's going to close in a little bit. We may end silver somewhere about 33.60, 33.75. We'll see what happens on Sunday when the markets open back up. But, silver could fall back down. But if it does, it probably won't come below that $30 mark. Remember when I said I didn't think silver would come below 30? I thought that there could be a pullback in gold and silver, and there was like a little mini pullback if you look at gold. Let me get a shorter term chart on gold here for you. We did have a little mini pullback here from about September to beginning of October. Beginning of October, a little pullback, and then gold's broken back out. Silver essentially did the same thing. Let's get back to like a 1-year chart. You had a bit of a pullback in silver in that same time frame, beginning of October, and it's just running. And it looks like you're not going to have a big correction right now. There's just too many countries overseas wanting the physical, and they're breaking the scheme by the bullion banks to control it. Remember, going back to the bullion banks, who owns the gold and silver trade? It's these 4 banks. And who has most of it is JPMorgan, with a sizable position also by Citibank and then a couple other banks. So really, it's JPMorgan, about half, again, of that of Citibank, controlling this market here. That you have the 4 list traders, 39% short on silver. Now moving over to gold, same thing. They're 277,000 short to 44,000 long. That's almost a 7-to-1 ratio. Who is it? It's these 4 banks. Who is it primarily? It's JPMorgan. Whether for themselves or on behalf of somebody else. Maybe they're doing it for the Chinese and the BRICS nation so they can pull the metal off. But it puts risk on the balance sheet of that bank. And what we may see is a rout. And if we get a rout on the COMEX, silver's going to go straight up. Remember what happened in nickel on the LME? It was a couple of years ago now. 1.5 to 2 years ago, whenever that was. Whenever you have a run, it just goes. And that's essentially what we're seeing. Looking over at gold futures, let's look at the trade. 199,000 volume on 557,000 contracts, mostly in December. As you can see here, this is December. We're going to have big deliveries in December, gold and silver, mark my words. Clearport 60.98, block trades 1,090, trade after settlements. Those are all, negotiated and put onto the chain to try to avoid volatility and try to avoid the bullion banks who are sitting at all this freaking high shorting. That's why they're doing it that way. They're using alternative methods to basically trade that market. The appease of 5,000 contracts. People are like, I can't get it on COMEX. That's why we think there are shortages. They're going across the pond to try to get that metal. Well, what about gold? Goldman Sachs raised their gold price target to 2,900 by early 2025. We're sitting at 27 and 18 right now. Goldman Sachs says 2,900. Why? On Kiko News, Goldman Sachs announced on Monday that it has raised its gold price forecast by $200 an ounce from 2,700 to 2,900. I'm glad they did because it's over 2,700. We reiterate, quote, our long gold recommendation due to the gradual boost from lower global interest rates, structurally higher central bank demand for gold, and gold's hedging benefits against geopolitical, financial, and recessionary risks, the bank said in a note. In other words, the stuff's hitting the fan, the central banks want it, price goes up. Not hard to figure out. Goldman Sachs also raised its average gold price forecast for 2024 to $23.95 an ounce from $23.57 because the end of the year is going to be higher. Our nowcast of central bank and other institutional demand in the London over-the-counter market shows that purchases remain strong through July, averaging 730 tons annualized year to date, or about 15% of global annual production estimates, with a large contribution from China. The analyst said that the moderating but still significant central bank purchases in the London OTC market would be responsible for about 2/3 of their expected rise to 2,900 in early 2025, with a gradual increase in exchange-traded funds, ETFs. So Goldman is predicting big things for gold. Let's look at gold's chart. It's running. Run, baby, run. Cup, handle, breakout. Said it for 2 years. People said, oh, it's not going to happen. No, it's not going to happen. Cup, handle, breakout. Cup, handle, breakout. What's going to happen in silver? Let's do a long-term chart on silver. Cup, deep handle, even bigger breakout. The deeper the handle, the bigger the breakout. That, ladies and gentlemen, is what's going on with precious metals today. It's about 27 minutes. We're going to wrap it up. Y'all have a good weekend. God bless everyone. Enjoy the bull market in gold and silver while you can. I expect a pullback at some point, but I think long-term it's going to rise so much. It's going to be hard for the average person to afford an ounce of gold, and that's what's going to drive people to silver, and silver is going to run even harder. And at some point, given that mine production we talked about at the beginning of this podcast, we're going to run out, and then silver straight up. To what price, I don't know. Maybe it fulfills my prediction in 2010 when I wrote on Seeking Alpha that at some point, an ounce of silver could equal an ounce of gold because monetary demand and shortages. I called that now almost 14 years ago. Will that come to fruition 15 to 20 years later in the next couple of years? I don't know. I could still be crazy, but look at the dynamics of silver. This thing could just blow the hell up, and it definitely is with prices as we see it on the market. Till next time, Rob Keats with the Freedom Report.